Hey everybody, Marty Mazur. Good afternoon, March 16, 2016. Quick commentary for you, then a peek at the charts. Well, the Fed surprised me today. Not that they didn't raise interest rates, that was a surprise to no one. But I honestly expected more, quote, hawkish language. I firmly anticipated that the Fed would um, warn the market that 2016 is going to see its share of rate increases. And I base that on what I'm seeing in the economic indicators. I'm basing it on what I'm seeing in the inflation data. And you can also even support that notion because we're coming off of a pretty nice rally in the stock market. Instead, the Fed, now, while they did suggest that there's going to be a couple of rate hikes this year, in December, they opened up a possibility or more likelihood of as many as 4 rate hikes this year. Well, they walked away from that, or they backed away from that. And I got to be honest with you. I think in a nutshell, I think this Fed is exceedingly sensitive to financial markets. The market experienced a noticeable correction after the December meeting, and I think that rattled folks at the Fed. I think they're afraid of the wealth effect, that if the financial markets suffer too much before this economy is really taking off, they could actually they could get the blame for moving us closer to the next recession. Also, I do think they're very concerned about the US dollar. While other countries' central banks are employing measures that could ultimately weaken their currencies. It hasn't been working for them much lately. That would potentially strengthen the dollar if the Fed raised interest rates in the near term or got too aggressive raising interest rates. The dollar didn't rise today. Of course, on that commentary, it fell. But I also kind of expected that they kind of had a green light, not to raise today, but to give the market a strong indication that they could raise the next meeting or in June, and maybe 3 times this year. Because the dollar really hasn't been strong on news that maybe it otherwise would. And that gets back to a currency conversation that we had several times last year. And I don't really expect the dollar to go booming higher, even while the Fed raises interest rates during the course of this year. So the Fed did something that was very market friendly. The Dow at one point was up well over 100 points, closed up 74 points today. It was very dollar friendly if you want the dollar to stay where it is or decline. And it was very bond market friendly as well. So the interest rate sensitive issues did well. Utilities had a good day. The 10-year bond, I'm just looking for it was down 1%, back down to 1.938. So bonds rallied today on that news. Financials did not do well because financials are poised to do well when interest rates begin to rise. So folks, suffice it to say, it's going to be a very interesting year. I think the Fed succumbed not to the data, but to their concerns over the financial markets and the currency markets. So you have in front of you my 60-day, 60-minute chart, and I want to work on it a little bit with you here. I'm gonna go ahead, and we talked a lot about this rising wedge pattern. We started talking about it here, and I told you that was bearish, and the market did break down out of that to the low side. It did rebound fairly quickly. So I'm gonna go ahead for now and get rid of that particular trend line, and I want to focus now on this one because this would be our new support line. I'm just gonna make that solid. Okay, so now, as you can see, when you draw the area that now has essentially 3 levels of resistance, which makes it significant or begins to gain in significance, and then you have the support line down here, suddenly we're working our way into another rising wedge pattern. And again, the technician's textbook would tell you that we tend to break out. That tends to be a bearish sign, and you tend to break out to the downside. I will say this, however, this market is holding up above some technical levels quite nicely, and I think the most important of which being the 2010, which is that 62% retracement back from May's all-time high. You can see we tested it yesterday and passed, and then came up above it very strongly today. closed again above the 200-day moving average and closed firmly above this downward sloping wedge pattern. I'm sorry, not wedge pattern, but trend line. Too soon to move that up in my view, so we'll see what the next few days holds because, again, if that rising sloping wedge pattern does do what they tend to do, then you'd see it break down, and I don't want to lose this trend line just yet. But folks, I think I think there's reasons to be bullish. If you watched my TV interview this morning, you heard me say that some of the underpinnings, like breadth in the market, are suggesting to me that I shouldn't be surprised, or you and I shouldn't be surprised if we don't test this May all-time high, or we shouldn't be surprised if we do, sometime over the next few months. I do think that as we get closer to the election, there's a whole new style of uncertainty that we're going to have to talk about. But again, I think the market is noticeably overbought on a short-term basis, so it would not surprise me if we don't pull back some from here and test another level, maybe that 50% retracement before we move up and potentially test the all-time high in May. Folks, none of this has to happen. It's not important that it happen for you and me from a long-term perspective. What's more important is we're well diversified, that we're in the right sectors, and that we remain patient and allow for a volatile year in 2016. So I'll say it once again, this is me helping you put the short term into perspective, because I found that with clients, the better understanding we have about the day-to-day volatility, the less we get rattled by it. So I'll leave it there, and of course there'll be much more to come over the next few days and over the weekend, and I hope you have a great rest of the day. Take care.